Our partners and our managers and seniors are all available to give you career guidance and support you on your journey.
I was attracted to work for Davidson & Company mainly for the employee retention. When I had met people at all the accounting recruiting events, everyone had been around for 7 or 8 years. And that really stood out to me in the accounting world.
This is a place where everyone's individuality and uniqueness are not only accepted, but celebrated.
We have a great onboarding process, mentorship program, and offer on-site training for CFE prep.
Some of the perks we have are a competitive salary package. We have extended healthcare, we have fitness credits, we have multiple social events that we put on throughout the summers.
We don't expect you to be perfect, we just expect you to be receptive, because that means we can teach you good habits, we can teach you the Davidson way for doing these engagements.
Just be yourself, come say hi to everyone, because everyone over here is approachable, and don't be shy.
For somebody who's thinking of joining our firm, I would just say go for it. Don't be afraid to ask questions and don't be afraid to work on your own learning and development as you grow with the firm.
Relax, be yourself, and enjoy the process.
This is where you want to be.
Coming in as a co-op student, that was an opportunity in and of itself, the opportunity to just try, come in for 4 months and kind of dip my toes, kind of see, okay, what is accounting?
The opportunity for growth and development here at Davidson are limitless.
Well, I was a student in Kelowna, and I went through the recruiting process, and all of the firms demanded that you started in either one specific role, whether it be audit or tax. I found Davidson didn't hold me to that role. They allowed me to explore my interest in tax without making me do the audit stream first.
There are no limits on the opportunities for growth and development of someone's career at the firm. We provide opportunities for our staff to have the experiences and the challenges to help to support their career path that they choose.
At Davidson, you get exposure to the whole audit file due to the nature of our clients, and this in turn prepares our students very well for the CFE exam.
Accountancy is the same across the board, but in Davidson, you're not just a number across the world. Like, we know who you are when you walk in this door.
We work with clients really all over the world, and that comes with a lot of benefits. First one being obviously the travel component. Great way if you want to travel, see the world for work. Definitely there's opportunities to do that. For me, I take advantage of it in the sense that you get to practice languages really.
We're a group of talented and ambitious professionals that are diverse, high-performing, yet humble. So it really makes it a place where you can come, be yourself, and belong.
What makes Davidson & Company fun is it has to be the people and, of course, the social culture.
No egos about people. We can all sit around, have a good laugh, but at the end of the day, we get the work done as well. So it's a really fun environment to be in.
I come to work and I never know what I'm going to be doing. Could be a different industry, could be a new client. And I like the non-monotonous days that we have at Davidson.
Again, the social committee takes really extra efforts to keep the firm always lively, always active.
So some of the events that the social committee puts on, a Sunrun, Adopt a Family, Nooner at the Nat. We have a great one called the Davidson Derby that includes all of our new students and staff. We try to have an afternoon of fun.
My favorite event at the firm is the annual golf tournament. Good food, cold drinks, and good company.
The firm has a Lunar New Year lunch. We talk about the New Year resolutions. I think it's a very, very nice event to show that Davidson is actually, value all different culture and diversity.
I love everyone that I work with. I've founded great relationships here. It hasn't made me want to look around for other employment. I'm a lifer here.
Welcome everyone to the
Davidson Tax Update. For those of you who I haven't had a chance to meet, my name is Les Fabian. I'm a partner and practice leader for the tax and private enterprise at Davidson. So it's been a few years since we had this event in person. We still have some people watching virtually online, but it's great to see a lot of familiar faces again and to be able to do it in person. It's always nicer to speak to an audience than a camera, so great to have everyone with us today. It's actually a special year for us. Some of you may know it's our 40th anniversary this year for Davidson and Company. And a firm that all started with our fearless founder, Bill Davidson. So that must have made you about 10 years old when you started the firm? Yeah, that's about it, yeah. So personally, I've had the privilege to be part of Davidson for most of the last 20 years, and it really has been amazing to see how far we've come and how much we've grown, while still maintaining our tight-knit group and our identity as that small firm, but taking on the big challenges. So it's been a great 40 years and onward. So the last few, like I said, have been done virtually. So I know the group, the presenters, they had to put pants on today and come on downtown, and so it's a treat for us too. So I'm sure most of you have seen some of the tax in the news lately, and with capital gains changes, things like that. So we're hoping to go through a lot of those things today so that you kind of get up to speed a little bit on those things. I mean, the changes that have come in the last 5 or 6 years are enough to make the tax accountant's head spin. So it has been a challenge just keeping up. And certainly 2024 has been another year where there's a lot of changes coming through. So we're going to try and hit the highlights today. Hope to hit those areas where your interests are, and otherwise, any questions, we'll take those as well. So just a bit of housekeeping. So on the chairs, there's question cards. So if you do have a question, don't hesitate to write it down. You can hold it up and one of our admin staff will come and gather them. We'll do the Q&A at the end of the session, but if things pop up, certainly let us know. Later on, you'll get an email after the session with a survey, so please do fill it out for us so that we can improve where we can and give us your feedback. Once that's done, you'll get a PD certificate and access to the slides that we're going to have today. And then we'll also have, as usual, we'll have a cocktail hour afterwards, and hopefully we'll be able to have a chance to say hi to all of you. So now, as I say, on with the show. So we've got a few topics this session. So our partners Jamie Nguyen and John Durrani are going to talk about the private tax changes, which are going to include a lot of the capital gains, the AMT, the alternative minimum tax, those types of things, and the further changes with trusts and other private company issues. Following that, Howard Chang, another of our tax partners, is going to do the international update. And that, again, every year it's changing and getting more challenging. So that's another area where the challenges never end. Following that, our partner, Pubco tax partner, Sun Kim, is going to go into the mining tax sector update. I'm sure a lot of you are interested in things like the flow-through and different tax credits that are coming along. At least there's some more good news on that front with some tax incentives. And then last but not least, Minisa Ho, our U.S. tax principal, is going to go into some of the U.S. tax updates that some of you may be interested in. So without further ado, I'll hand it over to Jamie here, and away we go. Thank you.
I'm going to set my timer so I don't talk too long, which I tend to do quite a bit. Hey everyone. So for those of you who don't know me, my name is Jamie Nguyen. I'm a tax partner at the firm. I specialize primarily in private entity and personal tax. So this topic today that John and I will be talking about is primarily focused around the federal budget for 2024. There's obviously a few very big topics that came up. So we'll try and break it down as simple as possible. This is the agenda of it. So the federal budget was announced in April 2024, as many of you know, the biggest change being the capital gains inclusion rate. And there's a whole bunch of other measures that just kind of trickled down from that, and John will be talking about that. So changes to the capital dividend account, the lifetime capital gains exemption, employee stock option benefits, and so forth. I put this giant asterisk here because of the instability of our politics here in Canada. Who knows what's going to happen a year from now? All this stuff that we're talking about right now might just get reversed. So just keep that in mind as you listen to our topics. So with that, the very first topic is probably the biggest one, is the capital gains inclusion rate change. Definitely the biggest change that was announced by the federal government this year. In recent memory, I can't think of another bigger change that's caused widespread panic among everybody. So for those of you who don't know, capital gains, the full capital gain, so you think of capital gain as equal to your sale proceeds minus your costs, that's your capital gain. It's not fully taxable. Usually, typically before this rule change, only 50% of it was taxable. And now that will be changed to 2/3 or 67%. And that was for dispositions after June 24th, 2024, which a lot of us are still wondering how that date came up. So now, when it comes to that increase in that inclusion rate, it will actually differ depending on the type of taxpayer. So individuals will still actually get access to that 50% capital gain inclusion rate up to $250,000 of net capital gains, and anything over and above that will have an inclusion rate of 2/3. For all corporations and most trusts, there's no ramping up. Basically, the first dollar of capital gain, it will be subject to an inclusion rate of 2/3 or 67%. There will be some of the things that have kind of come out from the legislation that was announced in August. Some questions that came up were, for individuals, do you get the carry forward of the annual limit if it doesn't get used? Unfortunately, that's not going to happen. So if you don't use it, you lose it. The one, I guess, positive measure that came out of it is because the change occurs for dispositions after June 25th, the question was the government going to prorate that $250,000 threshold for this 2024 year? And fortunately, individuals will get the full $250,000 for the 2024 year. And unfortunately, there will be no grandfathering. That was a topic that came up during the summertime of whether or not the government would allow people to crystallize gains at the 50% inclusion rate, and they basically said no. So if you held, for example, an asset for the last 20 years and you sell it today, it's going to have an inclusion rate of 2/3 or 67%. So definitely very big changes. This is a slide of the inclusion rate changes. Basically 50% were the old rules, and now it's essentially 2/3, except for individuals. Again, they get the $250,000 threshold. So let's kind of rewind time to June. I think that was a kind of a state of panic for a lot of people. So the federal budget was announced in April. A trickle-down effect for a lot of practitioners was, okay, what are we going to do now, right? We had a lot of clients that came to us in May and June and saying, what should we do? Should we, especially for the people that have corporations, especially holding companies, that have a lot of investments, the question was, should we sell these investments now, take advantage of the old 50% inclusion rate, or should we wait until after June 24th and sell it, 2-3 years from now, right? Because obviously there would be a definitive increase in the tax. So yeah, a lot of planning, a lot of what-if scenario analysis done for our clients. And that included people that held, like individuals that held assets that end up actually closing a lot of transactions before that effective date of June 25th to get that lower inclusion rate. So this is kind of an example, I think, of a lot of the scenarios we did for a lot of clients, because the question, especially this is one in the context of a corporation, I'll set the table here. It's a corporation, a Canadian-controlled private corporation that holds an asset. You just think of they're holding marketable securities. And the big question was, okay, Jamie, if I sell this asset now before June 25th, what does the tax look like versus what happens if I sell it after the rate change? So the first column, pre-change, that would be what happened if you sold it before June 25th, and the second column is what happens if you sell it after. So if you kind of go through the mechanics of it, I won't bore you guys with too much of the details. So you have a $100,000, simple situation, you have a $100,000 asset with a capital gain worth the same amount, 100,000, and you were to sell that asset. So you go through the mechanics of the calculation, you pay corporate tax, you then take those funds, those net remaining funds in the corporation, and you pay a dividend out to the end shareholder. And essentially you end up with about $70,000 of that. So in total, you're paying about 30% tax. If you wait until or after that change date and then you sell it, you can see immediately there's a 67% inclusion rate, and you go through the mechanics and you're now left with about $60,000. So basically a 10% spread by waiting to sell that asset after the rate change date. So one interesting thing, if you think about it, so there's a lot of panic among taxpayers in Canada saying, oh, I better sell this asset. But if you think about it, and this was my comment there on the right side, is if you defer selling that asset and you basically keep the tax that you would otherwise have paid to the government and you reinvest those funds over time, assuming you're making a decent rate of return, you will basically offset that increase in tax that you would otherwise pay. And I talked to a few financial advisors that ran some, scenario analysis, and they said, like magical number I think is 10 years. You have a decent rate of return over 10 years, you kind of more or less, make up that difference of that increased tax. So that was something that I think a lot of clients thought about. For a lot of our clients that, were probably planning to sell these assets in the short term, a lot of them ended up actually closing before that June 25th date to get the 50% inclusion rate. So moving forward now you guys know there's obviously this increase of the inclusion rate. What are the issues you guys should be aware of moving forward? The first point I would say is the tax compliance and the planning around it is just substantially more complex. I was talking to some people and they say, well, it's just a change in the inclusion rate, so you just change it from 50% to 67% and it's all done. It's like, well, actually, and John will go through this, there's a huge trickle-down effect in the Income Tax Act in terms of the capital gains inclusion rate. So it impacts, capital gains reserves, capital dividend accounts, lifetime capital gains exemption, stock option benefits, FAPI, the list goes on, right? And so there's many parts of the Income Tax Act that are impacted. So now it's figuring out, okay, how do you now deal with the transition year? The transition year being the 2024 year, because first half of the year has this old inclusion rate of 50%, and the other half, the new half, is now at 67%. So dealing with those transition rules is quite complex. Another issue moving forward is integration. That's a hot topic, and I'll go through some integration examples. And it's essentially going to be more costly to hold investments in corporations. So the question becomes, okay, should I keep holding my investments in the corp, or should I basically move them out? And my last point is, and this just might be more of a Jamie thing, the math isn't simple anymore. Like, it's easy to work with 50% or 1/2, but now it's like 2/3, 1/3, you have this threshold of 250. It's actually very difficult to do that on the back of a napkin now. So I find in meetings I'm having to pull out the calculator a little bit more. So just keep those issues in mind. So as an example of how I thought it'd be good to give you guys some numerical examples of how a taxable capital gain would be calculated for an individual in the 2024 year. So kind of pay attention on the first bullet. That's kind of the fact pattern. An individual has a capital gain of $600,000 on June 1st, so that's before the change, so what we call period 1. Capital loss of $75,000 in period 2, and a capital gain of $475,000 in period 2 as well. So the way you need to look at this is you actually need to, and it's not as intuitive as you might think once you go through the rules. You have to look at each period separately. So if you look at period 1, what are the net capital gains? Well, he has 600. So you know right away, okay, it's positive, okay. So you kind of park that aside, 600,000 is positive. Period 2 is also positive. You take 475 minus 75, it's positive 400, right? So what you know right away there is you're going to have what we call a blended inclusion rate. So what that really means is you're going to look at each period separately, calculate it at each respective rate, and then kind of add them up together, and that's what you get as your taxable capital gain. So period 1, $600,000, you use the 50%, the old rate, that's $300,000 capital gain, taxable capital gain, I should say. Period 2, you take the 400,000, you run it through that threshold, so 250 of it will be taxed, will have an inclusion rate of 50%, and the other 150 will be at an inclusion rate of 67%. That equals 225. So you take the 225, you add it to the 300, and your taxable capital gain is 525. And so you remember from my previous slide, I said the math is not simple anymore. Before, you could look at that first line, you'd be like, oh, a million, half, 500, and it's done. It's like now you got to kind of like go through the mechanics, and it's, you know, there's a little bit more work involved there. So just keep that in mind. The other issue, like I said, is integration, right? So integration with capital gains. So for those of you who don't know this concept of integration, it looks at, you take a source of income, and let's use capital gains obviously in this situation, and if an individual held an asset personally and sold that asset and created a capital gain and paid personal tax on it, in theory, that person should walk away with the same net cash as another person who had a corporation with that same asset, same capital gain, sold the asset in the corporation and then pushed it out. In theory, the overall tax should be about the same. And then if it's about the same, we say, oh, there's integration, right? And so under the old rules, you know, we had what we would call integration. It was off by a few percent, and I'll show you guys on the next slide of how that looked. And now with the rule changes, you can see the spread will get much bigger, and it's obvious. And that's why there's all this dialogue about whether or not individuals should actually keep holding their assets in corporations. So this is an old integration example. So if you think of a situation where on the left side, an individual holds an asset, wants to sell the asset, and you know, you end up with the net cash at the end. You compare that to a situation where a Canadian-controlled private corporation holds that same asset, same capital gain amount, sells it in the corp, and then pays it out. So if you look all the way to the bottom, you can see there's about a 3% spread. You know, the individual kind of comes out a little bit ahead by about $3,000 or about 3% difference. You know, for the most part, us tax people would say that's integration, right? It's pretty good, but just the mechanics of how all the tax rates work, you'd say there's integration there. And this, again, this is under the old rules where there's a 50% inclusion rate before June 25th, 2024. So now let's look at the new integration example. So what I did here is, instead of trying to confuse everyone with using an example with the $250,000 threshold, I just assumed the same rate all across. So in this situation, just assume the individual has an inclusion rate of 67%, so they're above that $250,000 threshold. So when you go through this situation, you can see that spread gets a little bit bigger, right? Before it was 2.8%, and now it's about 3.7%, a little bit higher. Still not bad, you know, assuming the 67% rate applies to both situations, you have integration. Now on this next example, this is where it really kind of blows through the roof, right? So if the individual has access to that 50% rate, so again, individuals have an inclusion rate of 50% on the first $250,000 of their net capital gains for the year. So if the individual has, you know, just imagine a situation, the only capital gain they have for the year is $100,000, they will end up with net cash of $73,000. You can see at the bottom there. You compare that to a corporation, there's no ramping up, there's no threshold, right? So the inclusion rate is 67%. You end up with $60,000. It's a 13% spread. Like, that's a very big amount of tax, right, between those two scenarios, right? So again, hence why a lot of that planning went in during June about whether or not to basically sell assets in the corp or hold off. So definitely integration is going to be a problem moving forward unless all of the other tax rates change along the way. Another thing that came out of the federal budget and the legislation is how do capital losses work. So, for those of you who don't know, capital losses can only be applied against capital gains, and if you have any residual capital losses, they can be carried back 3 years and they can be carried forward indefinitely, right? So obviously if you had any capital losses before the budget came out, they can still be applied to future capital gains, but the question became, how does that application of those capital losses apply? In a nutshell, if you have think about it before the inclusion rate is applied. So if you have a capital loss of $100, in theory, and you had that say from 5 years ago, you should be able to apply that dollar for dollar against a capital gain of $100, say now or next year, and it would fully offset. So that's a good thing. Capital losses will also be applied first in terms of ordering. It will be applied against the capital gains that are subject to the higher inclusion rate. And I'll go over an example of how that works. This is what we call the net capital loss adjustment factor. It's kind of confusing unless you actually work through the mechanics of the tax return, but it's a fancy way of saying if you have net capital losses from an earlier year, say when it was at 50% rate, what do you multiply it against to determine the deduction you get against your taxable capital gains? So as an example, if you had a net capital loss where it had a 1/2 rate, say from last year, and you want to now apply it against a capital gain in the current year that's at a 2/3 inclusion rate, you would multiply it by 4/3, and that's the deduction you would get. So ignore the writing. I'll show you guys it more in a Excel style format. Just look at the first 3 lines of the fact pattern. So I'll go through an example of how this capital loss is applied from a prior year. So you imagine an individual in the current year, imagine 2025, so we're putting aside the transition year for a moment, has a capital gain of $450,000, has a capital loss of $50,000, and they had some losses from the prior year, say the 2017 year. So capital losses of $300,000 or net capital losses of $150,000. And they want to apply those losses against this current year's gains. So how would that be calculated? So this is the kind of the mechanics of the calculation. So you look at just kind of like your current year capital gains, you take the 450 minus the 50, you have $400,000 of net capital gains, and then again, you have these capital losses from the prior year of $300,000 or net 150. So how do you calculate taxable income? Well, you have $400,000 of net capital gains, so you go through the threshold calculation and you end up with a taxable capital gain of $225. Now this is where it kind of gets a little bit confusing, I think, when it comes to the capital losses that are going to be applied. You can see there's that $100,000 of the taxable capital gain that was subject to the higher rate, right? The 150 times the 67%. So what happens is you also get a deduction of $100,000 of your capital losses against that. So you kind of work backwards, and that translates in a nutshell to $75,000 of your net capital losses, or $150,000 of your gross capital losses. And then the remainder of that was subject to the lower inclusion rate, and that's how you get the second part of it, which is the $75,000. So $75,000 times 1 as the adjustment factor, and your total deduction is $175. So $225 taxable capital gains, subtract the net capital loss deduction of $175, and your taxable income is $50. Now, if you kind of also step back and look at it, if you ignore the complexities of that calculation, and it hurt my brain to have to go through that, but if you just take the 400, you subtract the 300, you end up with 100, you apply the old or the 50% rate because it's under the threshold, you get to the same answer. The reason why I think it's important to show this breakdown at the bottom is because that's actually how it'll show up on the tax return. You'll see your taxable capital gains show up kind of near the top of your return, and then later down below is your net capital loss deduction. So if you're wondering how it's calculated, you now have the tools for it. Partnerships and trusts. So most of you guys know, I think partnerships and trusts can often act as flow-through vehicles to the end investor and beneficiary, and the source or the type of income is preserved. So if you have a capital gain in a partnership and it's flowed through to the investor, that investor will see that it's a capital gain and they'll report that as a capital gain on their personal return. So under the new rules, that same logic will apply. It'll still be a flow through, and now, in particular, I would say for the 2024 year, partnerships and trusts will now have to disclose the period that the capital gain arose in the partnership or the trust, so that obviously the individual can determine if the 50% rule inclusion rate applies or the 2/3 rate applies. Each individual investor or beneficiary would still get obviously their respective $250,000 threshold. The graduated rate estates and the qualified disability trust will actually are the two types of trusts that will actually be eligible for the $250,000 threshold, because obviously they are taxed in the same manner as an individual. So it's good that the government allowed them to get that threshold. Another follow from the capital gains inclusion rate change are capital gains reserves. So what ends up happening, I don't know how familiar people are with capital gains reserve, but generally capital gains are fully taxable in the year they arose. So if I sold something in 2024, I have to report the full capital gain. So that's irrespective if I receive the funds now or receive them say next year, right? But there's a special rule in the Income Tax Act that allows what we call a capital gains reserve to be claimed, and basically defers the taxation of that capital gain to the year the funds are received. So the mechanics of it is you report the full capital gain, you say, oh, okay, there's a portion of the proceeds are not received, I'm going to claim a reserve and I get a deduction. And the next year, that reserve that you took in the prior year comes into income until essentially you fully included that as income. There is a maximum deferral of 5 years. So now the question becomes, how is this capital gain reserve going to apply in light of these new rules? So you imagine a situation, I'll kind of break down a simple example because I think reading it will probably sound confusing. If you imagine a situation where 2023 you had a capital gain, and let's say I sold something in 2023 and I didn't receive all the proceeds. So I'm like, okay, I want to defer the taxation of this capital gain to 2024 when I'm going to receive a portion of the proceeds. So on my 2023 tax return, I would report the full capital gain. I would take a capital gain reserve or a deduction to almost nullify that capital gain inclusion in the 2023 year. So on my 2024 personal return, I would now include that reserve as income, right? So let's just assume I'm now receiving those funds, right? And there's some nuances to the calculation, but just you'll get the gist of it. So now I received the funds in 2024. I'm now going to report that capital gain in the 2024. So under these new rule changes, the question is, oh, okay, so Jamie, you're going to report that capital gain in 2024. Do I apply the 50% rate or do I apply the 67% rate, right? And intuitively, you guys might say, well, the capital gain arose the disposition arose in 2023. I should definitively get the 50% inclusion rate. And that might not always be the case. So in that situation, the rule says that I'm considered to have received or report that capital gain as if it happened on the first day of my taxation year. So I'm going to it's going to assume that I received that capital gain inclusion on January 1st, 2024. And obviously that's under the old rules, so I will at least get that 50% inclusion rate. So that's good. But now you think of the 2024 year, this is where it gets tricky. If I sold an asset on January 1st, 2024, so I'm like, oh, or let's say in May. So I knew the rule changes were going to happen, and I'm like, oh, I better sell this asset in May before the rule changes happen. So let's say I didn't get all the proceeds. So I said, I want to defer the income inclusion to the 2025 year, right? So I would take a deduction on my 2024 return as a reserve, And now the question is, on January 1st, 2025, I'm now considered to have received that income. Well, at that point in 2025, I now have a 67% inclusion rate. So I've now tried to sell, so now what's happened is I've now tried to sell this asset before the change date, and by essentially trying to defer that, I've actually created a higher inclusion rate for myself. So in a nutshell, be careful with the 2024 year in terms of claiming capital gains reserves, because you might inadvertently actually create more taxable income for yourself. So that's basically all of that gibberish I wrote up there. That's essentially what I said. So just on my last slide before I hand it over to John, so no more capital gains inclusion rate for me, is this purpose-built rental housing. So, you know, when it comes to rental housing, I think everyone's well aware across Canada there's this shortage of rental housing. And so the federal government put together some relieving measures to help facilitate or stimulate an increase of new rental housing. So some background for GST. If I'm a landlord and I buy a new apartment building, even though I may be a GST registrant, and let's say that apartment building for long-term residential use, I cannot actually claim back all of the GST. As many of you know, with GST registrants, you get the GST back. If you have an exempt supply, which long-term residential rents would be, I don't actually get that full 5% back. But what happens as a somewhat relieving measure under the old rules is you get 36% back of that 5% that you paid. And it only applies if the unit itself, the rental unit, has a value of less than $450,000. So many of you know in Vancouver, I mean, the chance of finding a brand new unit under $450,000 probably doesn't exist. So a lot of landlords basically don't get this rebate. It's just kind of like, it's a nothing. So they're basically paying 5%. And for income tax purposes, if you have a residential rental property, the CCA rate or the tax depreciation is claimed at 4% per year. So it's really, both have very limited benefits for landlords. So the two main relieving measures announced on the GST side is that 5% can now be fully claimed, so you can actually get a 100% rebate on the purchase of a property or a self-supply of it. That only applies for new builds after September 13th, 2023, and it has to be started before 2031 and has to be completed by 2036. On the income tax side, they'll be bumping up that rate from 4% to 10%, so that's also a welcome addition. And at the provincial level, the BC government announced also that you might be eligible for a full property transfer tax exemption for new rental buildings between 2025 and 2030. So that's it for me. I'm now going to hand it over to John to talk about the rest of the budget changes. Thank you.
Hello, everyone. So as Jamie had alluded to earlier, there were a whole bunch of changes for capital gains as a cascade effect of the capital gains rate changes. So I'll spend a bit of time talking about those and a couple other changes from the budget. One of the impacts is for the capital dividend account, which, if you're not familiar, it's basically a way for shareholders to extract the non-taxable half of capital gains, or now non-taxable third of capital gains, out from a corporation without having any further tax assessed onto them. And this is something where I have to actually give a little bit of credit to the government for fixing the first draft of how they had this stuff set up, and instead they've adopted a very pragmatic approach for dealing with the blended tax rate situation that would end up coming up, where if you had gains or losses in both period 1 and period 2, what they've done is said if you have a capital gain or a loss in period 1, being the period ending June 24th, that will have a 1/2 inclusion for the CDA balance, and if it happened in the second half of the year, then it'll have a 2/3 inclusion rate. The reason why this is important is because the capital dividend account is a point-in-time test, and having having this is a measure of certainty for declaring capital dividends throughout the year. Now, the important part here is that at the end of the year, there will almost certainly be a true up to your capital dividend account, because ultimately what the CRA wants is to have the capital dividend account equal to that blended rate that's only calculable at the end of the year. So there'll be a discrepancy up until, if you have a calendar year end, there'll be a timing difference for your CDA that gets adjusted on December 31st or whenever your fiscal year end is, to make the capital dividend account equal to whatever it should be. Another change was the lifetime capital gains exemption. So this is a good change. The lifetime capital gains exemption is, generally speaking, if you're not familiar with it, a way to get an exemption against things like small business shares or farmland or fishing properties. And this was increased to 1.25 million for dispositions that occur after June 25th, 2024. For the last few years, this has been something that's been indexed to inflation. That indexation is going to stop for now, but it's going to resume in 2026. And similar to the net capital loss rules, the lifetime capital gains expense exemption deduction is going to be adjusted to align with the underlying capital gain. So what I mean by that, I'll kind of go through in this example here. So imagine that you have an individual that sells QSBC shares in the 2025 year, and just to keep it simple, it's a 1.25 million capital gain, and they have their full 1.25 million lifetime capital gains exemption available. So the result from this is you would have the first 250,000 included at that 1/2 rate, and then the remaining $1 million would be included at the 2/3 rate. So your taxable capital gain would be $791,667. And in that case, the purpose of this lifetime capital gains exemption is to shelter the entirety of that gain. So the deduction amount will be equal to the income inclusion. And the end result is that there's no taxable income, though there might be some stuff related to alternative minimum tax that I'll deal with a little bit later. One thing to note, though, is that you'll see that the deduction amount is lower than what the maximum possible deduction amount is, which would be 2/3 times that 1.25 million rate. So if there are other capital gains that existed for the taxpayer, the lifetime capital gains exemption will come off the top, and you'll be able to get, in theory, a larger deduction. One of the other changes relates to employee stock options. So in general, as you might be familiar with, employee stock options are meant to mimic capital gains that are realized on the ordinary purchase and sale of stock. And in general, the income inclusion that an employee has is going to be the difference between the fair market value of the shares at the time when they exercise them and the cost that is stipulated in the option agreement. So that gets included as employment income, and then there's an offsetting deduction that they're able to take when they meet certain qualifications. With the new capital gains rate being 2/3, the deduction will be commensurately reduced to 1/3 for those employee stock options. The one interesting thing with this is, imagine a situation where an employee has a stock option benefit and they also have an ordinary capital gain. That the legislation, what they're trying to accomplish is to have $250,000 of capital gains, or in this case things like capital gains, to be subject to that 1/2 rate. So the employee stock options also are available to be used at that 1/2 rate, so long as the combined total between the stock option benefit and the gross capital gain is going to be less than $250,000. If it happens to be more, you're actually able to choose the allocation that ends up happening to go and say, okay, I want this much of the stock option benefit to be subject to the 1/2 rate, or I want this much of the capital gain to be subject to the 1/2 rate. Now, the end result of this is the same amount of taxable income, but what it does is it changes the character of the income that gets recognized in a particular tax return. So where this is going to be most prevalent is from the utilization of net capital losses, which those can be applied against capital gains, but they cannot be used against the income inclusion portion of employee stock options. So having the flexibility to go and do this, given whatever the tax characteristics in your particular situation have, could yield some improved results depending on what else you have going on. Allowable business investment losses, or ABLs. What these generally are is if you have a loss that's to be recognized either on the shares or some debt on small business corporations. The ABLs allow you to sort of convert the capital loss into an ordinary loss that can be used against other sources of income. ABLs are able to be carried back 3 years and 10 forward, and if they don't get used for some reason for 10 years, the loss would convert into a net capital loss. But also, if you don't have income for 10 years, you probably have other problems besides the ABL not being used. The interesting portion for this is that the deductible portion of the ABL, when it gets adjusted from or if you're to carry it back, for instance, you realize it this year and you want to carry it back to one of the 3 previous years, it's going to maintain the integrity of that 2/3 loss rate if it was incurred after June 25th. So using an example here, imagine that an individual has a $36,000 loss on the dispositions of some bankrupt small business corporation. That would convert into an ABL of $24,000 with the 2/3 inclusion or allowable range in this circumstance. And if he was to carry that back, you would be able to use the full $24,000 against income in those previous years, where otherwise it would have only been $18,000. So it has a little bit of extra value there. With that said, and I say this every time I talk about ABLs, is caution should be exercised, strongly exercised, when you're considering claiming an ABL, because they are almost exclusively selected for CRA reviews. So if you're going to do it, just make sure that you have all your documentation in a row on the assumption that they're going to audit you, because it's almost certainly going to happen. Employee ownership trusts. So this is a concept that was introduced in Budget 2023. And the idea at that point in time was essentially a way for business owners to have a longer deferral of capital gain in circumstances where they're selling to a collection of their employees. And the typical situation would involve the employees setting up this employee ownership trust, the owner selling the shares of some target co into the employee ownership trust, and then the payment of a purchase price happens over a much longer period of time due to some favorable tax circumstances with it. So just as a kind of diagram for the structure there, typically you would have the current owners, the owner of Target Co. The employee ownership trust buys the shares, and then typically there's a loan that goes from Target Co. up to the employee ownership trust, and then that's used to kind of slowly pay off the old owner over time. The really nice thing that they did with this 2024 budget is they added in there that you can actually get an exemption for the first $10 million of capital gains as long as it's sold to an employee ownership trust. I mean, that's huge. That's probably the largest single deduction that's available to small business owners in the Income Tax Act. Now, there are a lot of qualifying conditions for it. You have to read the fine print. Most notably, I would say it's that at least at this point, the transfer needs to occur between 2024 and 2026. At least 75% of the beneficiaries, being the employees of the trust, have to be tax residents of Canada. The owner of the shares, the current owner, the vendor, needs to have held the shares for a certain period of time, and they need to have been actively engaged in the business for that same period of time. And then there's a whole bunch of other caveats in there where they're trying to avoid people duplicating the benefit of this by constantly rolling things into new employee ownership trusts. So essentially, the same way how the lifetime capital gains exemption is sort of tied to an individual, this EOT matter is tied to shares. So if a share has already been used to benefit from these EOT exemptions, you can't use that share again to benefit from it again. Now, how can this get taken away? So in the legislation, they refer to this as a disqualifying event, and it would essentially cause that $10 million deduction to the vendor to be denied. This could occur if the EOT loses its status as an employee ownership trust, which could happen over various circumstances, or if the principal business of the business ends up becoming more of an investment business. What that line is just saying there is that more than 50% of the value needs to be involved in the active business assets as opposed to investable assets. If the disqualifying event occurs within 24 months of whenever that transfer happened to the employee ownership trust, then the deduction is retroactively denied from the vendor. But interestingly, if it happens after the 24 months, then the employee ownership trust, that is the thing that's benefiting all these employees, it's the one that's going to have to shoulder the burden of the capital gain. And I think the idea there is to have some sort of endpoint or indemnity for the vendor, so that they're not permanently on the hook for the activities that are undertaken with the business after they leave the business. So it's a pretty clever way to go about it, but I'm sure it's going to make a lot of work for lawyers to make sure that everybody's on board with the terms of these trusts. Another positive thing to come out of the budget was the Canadian Entrepreneurs Incentive. What it essentially is a reduction in the effective capital gains rate by 1/2 of whatever the prevailing rate is. So right now that prevailing rate is 2/3, so this would make it 1/3. There's a lifetime maximum of $2 million for this, similar to the lifetime capital gains exemption, and it's going to be phased in over time. So we're going to get the first $400,000 being available in Jan 1, 2025, and it's going to add $400,000 every year up until 2029. This was something that was changed from the first draft, where it was $200,000 per year over 10 years. So maybe it'll change again between now and whenever this stuff ends up into legislation, if it ever does. So we'll see how that ends up playing out. And of course, this can be used in conjunction with the existing lifetime capital gains exemption. So it can offer quite a bit of opportunities when you think about this, the employee ownership trust, thinking about the lifetime capital gains exemption, for ways for business owners to exit on a fairly tax efficient manner. There are a number of requirements for it. It's similar to the lifetime capital gains exemption for a bunch of things. Then you have to own 5% or more of the company. You have to be actively engaged in the business. But most notably, it excludes a whole bunch of types of businesses. So the list is up there, but professional practices, consulting, financial industry, insurance, real property, short-term accommodation, arts, restaurants, this is really common things. So you want to make sure, particularly if you have a business that's adjacent to some of these things, or maybe partially involved in some of these things, that you're seeking appropriate tax advice to make sure that you're going to qualify for this in the event of an exit. AMT, we spent a lot of time talking about this last year, so I don't want to rehash everything, but the big picture thing for AMT, if you are unaware or if you've forgotten, is essentially that it's like a second ghost calculation of your taxes following a different set of rates and inclusion percentages. And the idea is that you calculate your taxes the ordinary way, you calculate your taxes the AMT way, and if the AMT way is higher than the ordinary way, then you owe extra taxes in the form of AMT. Unfortunately, it doesn't give you a benefit if it's lower than the ordinary form of tax, but maybe you'll be able to use your AMT carry forwards in those circumstances. So this is just a whole bunch of things for what 2023 did to the AMT. I won't go through all of it, but the big picture items, AMT percentage changed from a 15% effective tax rate to a 20.5% effective tax rate. So what that means is, you know, when we're comparing those two liabilities, the AMT liability will be that much higher. And then all of these other calculation items, what they do is they're going to increase that notional taxable income under the AMT. So we have one that's increasing the rate and then the other one that's increasing the income. So it's a double whammy there for everything, and we're going to see the impact of AMT come up, I would say, quite immediately for the 2024 year. Some of the nice things that they've done for budget 2024 are fairly minor, but the first one in particular I would say is worth mentioning. You know, part of the AMT calculation related to sort of punishing people that made charitable donations. So they're still punishing people for it, but they're not punishing people quite as badly. So I guess that's good. They made some allowances for low income related things, for some logging earmark that surely made its way in there. The employee ownership trusts that we talked about will be fully exempt from AMT. And then there's some carry forwards that will apply as well. So for the most part, there aren't a lot of differences, but this is your reminder that if you had a lot of tax preferential income, that this is going to be something to really consider. And like here, particularly if you're a high income earner with significant capital gains, so those of you that liquidated a whole bunch of your stuff prior to June 25th to go and crystallize those 1/2 rates, you better start calculating your AMT because that is definitely going to be an issue. Stock option benefits, deductions, donations, all of those will impact it. One nice thing about the AMT is that it doesn't affect things at the corporate level. So if you're thinking about making those charitable donations, if you have a corporation, you know, you can consider making the donation through your corporation instead of in your capacity as an individual. And the other thing to remember about AMT, just to stimulate some of the panic, I guess, is it's a prepayment of sorts, right? It can be recovered over the next 7 years. So as long as you have some sort of source of income, that you'll more likely than not be able to recover a lot of that AMT. And then just a couple isolated topics here. So one is related to dispositions of taxable Canadian property owned by non-residents of Canada. So TCP is generally going to be things like real property or mineral properties. It can include a variety of other things, but those are some of the most common for our clients. And in general, if a non-resident sells a parcel of TCP, the purchaser of that property is required to withhold and remit 25% of the gross proceeds of that sale. Now, the change in the budget is that this is meant to reflect the increased capital gains rate. So they're going to increase the withholding tax rate from 25 to 35% for dispositions that occur on or after January 1st, 2025. Now, the interesting thing here is for some reason they've picked Jan 1, 2025 and not the June 25th date of the capital gains rate changes. So normally with these circumstances, you end up where the non-resident files and gets a refund because their tax is fully prepaid. But in this circumstance, there's going to be any dispositions that happen in the middle of that time. The withholding rate is still going to be 25%, but the effective tax rate will probably be closer to 33%. So there's a likelihood that we're going to have these amounts owing from non-residents of Canada, and I'm very curious to see what the CRA's collections policy is going to be for chasing down people from third world countries or wherever else to try and get their money back. Trust reporting, I hope that none of you had to go through the agony that we had to go through this last year for March, but the latest proposal does have some good news for us on many of these things. So there were a lot of bare trust tax filings that were initially told we needed to file, and then 2 days before the filing deadline, the CRA said, well, actually, you know what, you don't need to file. So they've clarified, at least in advance now, that for the 2024 year, you will not need to file for bare trusts. The current plan is that there will still be a requirement for them to file for 2025, but it'll be a narrower group of bare trusts that will need to file. So if you had to file for 2023, it's not necessarily guaranteed that you'll need to file for 2025, but just come talk to us about it and we'll help you out. One of the other nice things that they did there was an expansion to the small trust filing exemption. So what it used to be is that it needed to be $50,000 of cash or near cash assets that are held by the trust. And one of the problematic things that there was with this is that a lot of trusts are settled with like a gold bar or a silver wafer, and that is not a cash or a near cash asset. And so you would have all these inactive or functionally inactive trusts that were required to file. So now what they've done is they said, okay, as long as it's less than $50,000 in value in total, it doesn't matter what the asset is. You won't need to go and file. And then there's another reporting exemption for related trusts. So this is in family situations where the trustee and the beneficiaries are all related to one another, and the trust holds assets with a fair market value of $250,000 or less. This one does have an asset test, but it's a little bit better than the old small trust one. So it's cash-like assets, and securities on public exchanges, public trusts, those basically things that you would commonly trade in public markets. The threshold is still kind of low, but at least it's better than nothing. So the summary for the 2024 budget, we had many significant changes over this period. The themes are generally consistent with prior years. Taxes are increasing. Complexity is increasing. The cost of keeping up with all the compliance is increasing. And so, our general advice is to seek the appropriate advice depending on whatever your situation is. Consider how these new transitional rules are going to apply for all the capital gain inclusion rates that Jamie was talking about earlier, as the results might not always be what you expect. And always keep your plans up to date in the face of changing tax landscape. As Jamie alluded to earlier, we have some political uncertainty coming up, and we want to make sure that your plans are up to date in the face of that and even what the current proposals are. Thank you.
Thanks, Jamie and John. Yeah, lots to digest there. I know that was pretty detailed, and luckily you'll have slides to refer back to it when you're actually trying to work out what's going on. Certainly with the trust reporting, and especially with the underused housing tax, yeah, it kind of felt like Charlie Brown getting the football pulled. So yeah, I'm sure a few people had to go through that. Hopefully we won't have more of those coming along. So we're going to move on to the international tax. So Howard Chang will run us through that one. Thanks.
Good afternoon, everyone. My name is Howard. I'm a tax partner here at Davies & Company. My focus on public corporations as well as international tax. So today I have 5 topics. Hopefully one of these will be relevant to you in your situations, but the first 3 topics are recently enacted. The first one is the excessive interest and finance expenses, or for short, EIFEL. Second one is global minimum tax, GMT. And the third one is hybrid mismatch arrangement rules. The fourth one has to do with the topics that Jamie and John has alluded to, international tax impact of the capital gains change. And last one is just an update to Regulation 105 withholding tax. So for IFOL, it's actually a topic I've spoken about in the last few years because the rules were under proposal, but it's finally enacted on June 20th, 2024. It is effective for taxation years that begin on or after October 1st, 2023. It applies to all corporations and trusts, other than excluded entities, which we'll go through later. And the rules basically limits the deduction of net interest and financing expense, or net IFE, that exceed a fixed ratio of adjusted taxable income. And the fixed ratio is 40% for taxation years that begin between October 1st and December 31st, 2023, and 30% thereafter. So if you don't want to be within the rules, then you want to make sure you're within one of these exemptions. So excluded entities are three general categories. The first one is CCPCs, with taxable capital employed together with your associated corporations of less than $50 million. So if you're in CCPC, that's the rule to look at. If you're not a CCPC, you can also look at whether or not, together with your eligible group entities, that you would have net IFE in Canada of less than $1 million. So this is to give a break to those with interest expense that's not exceeding $1 million. And lastly, the last group of exemption is for groups that carry on substantially all of their businesses in Canada, and generally substantially all refers to about 90%. And that you don't have investments outside of Canada in excess of $5 million, and there's different tests for that. The last one is a little trickier to get into. There's also ownership tests that you need to look at to make sure that you can get into that. And so if the IFOL rules were to apply, these are the effects. So one is the interest will be restricted. The portion that's restricted can be carried forward indefinitely, subject to loss restriction events. So it can potentially be restricted that way. On the other hand, if you have excess capacity, so this is kind of the opposite situation where your interest expense is lower than your interest revenue plus 30% of the ATI, so lower than the threshold. This excess capacity can be carried forward and allowing you to deduct interest expense where in the future, let's say you pass the threshold, you can use the excess capacity to take the deduction in a future year. But keep in mind that it can only be carried up to 3 years. Excess capacity is also reduced where your IFE is less than your IFR or where the ATI is negative. If a group ratio is used instead of the fixed ratio in a particular taxation year, then you cannot accumulate the excess capacity in that year. And excess capacity does not survive loss restriction events, so please keep that in mind whenever you have reverse takeover transactions or acquisition controls. The cumulative excess capacity can be transferred between Canadian taxpayers within the same group, but keep in mind there is a mandatory ordering rule where you must first apply the excess capacity against restricted IFE carried forward from prior years before the remaining excess capacity can be transferred to another entity in the group to use. So here's a brief example where you have restricted IFE carry forward. So in this example, in 2024 and 2025, you have 100,000 and 120,000 respectively of restricted IFE. So you have a carry forward at the end of 2025 of $220,000. And in 2026, let's say you have $150,000 of excess capacity for that year. You may deduct $150,000 of additional deduction in that year from the carry forward. And your carry forward will be reduced to $70,000 going forward. On the other hand, if you have excess capacity, so in this example, you have $100,000 of excess capacity in 2024, $120,000 in 2025. So you have a cumulative excess capacity of $220,000. In 2026, if you have $80,000 of IFE that is otherwise subject to the IFO rules, the cumulative excess capacity will be automatically applied to reduce the IFE such that you have no denied interest deduction that year. And your cumulative excess capacity will only be $140,000 going forward. Okay. The next topic is the global minimum tax. So there's a new global minimum tax act. It's a separate legislation from the Income Tax Act, and it comes with two new taxes. The first is the 15% domestic minimum top-up tax, or DMTT. It applies in a situation where you have a foreign parent and Canadian located entities or Canadian permanent establishments. And basically it's to make sure that if the Canadian entities or the Canadian permanent establishments have a low tax rate that's below 15%, that is a top-up tax to that. And the second scenario is where you have a Canadian parent with foreign located entities and foreign PEs, that there's a 15% top-up tax if the foreign jurisdictions, the effective tax rate is below 15%. This ensures large multinational enterprise groups pay a minimum ETR on income in every country that they operate in. There's a threshold though, so this is only applicable to MNEs that have annual revenue of 750 million euros or higher. So, and this is on the consolidated financial statements of the ultimate parent entity. These two taxes will be applicable for taxation years that begin on or after December 31st, 2023. And this is part one of two. So the second part is a third tax called Undertaxed Profit Rule, UTPR, and it will be introduced in the future. So in general, Canada has about 27%, if you're in BC or, that's around the average tax rate in Canada. So 15% is, rather unusual to be applicable. And also the 750 million euro threshold is quite high as well. But if, let's say, the entire group, let's say a foreign parent has that kind of, that meets the kind of threshold. In Canada, you still have compliance requirements. So there are three things. One is what we call a Globe Information Return, or GIR. The second is a GIR notification. And the third is DMTT or IIR return. So the first two is more on information, the last one being an actual tax return if taxes are applicable. The GIR return is OECD standardized return, and it's to provide information about the whole group. And the following requirement: if a Canadian corporation is the ultimate parent entity in the group, then that is the entity that needs to file. If another entity, for example, foreign parent, is designated, then that entity will file. Otherwise, each constituent entities in Canada will need to file. It's important to, if you have multiple companies in Canada but no parent company, so let's say a foreign parent with, 5 Canadian subsidiaries, the 5 subsidiaries may need to file if the foreign parent somehow, for some reason, does not file. But you can appoint a designated local entity to do that one filing. Which the second one is probably the more common one, is if you have a foreign parent that is filing the GIR, then it is required for the Canadian entities to file a notification to indicate the identity and the jurisdiction of the foreign filing entity. And again, the responsibilities on each constituent entities in Canada, unless you designate somebody to do the filing. Last one, the DMTT or IR return. It was only applicable if these taxes are applicable, of course. And again, the responsibility is on every entity unless you appoint somebody to file. And why that's important is because the penalty is actually quite severe. For the first year in which the MNE group is subject to the rules, you have 18 months to file the return, whereas in subsequent years, you have only 15 months to file. Each failure to file the GIR by the due date may result in a penalty of $25,000 per month. For each complete month the return is late, up to 40 months, so that's $1 million per year. The penalty can also apply if the GIR is incomplete or if a notification is not filed. So that's where maybe more relevant is the notification side things. It is the same penalty. And in addition, late filed DMTT or IR returns may result in 5% penalty of the unpaid taxes plus 1% unpaid tax multiplied by the number of months that's complete months that is late. The third topic is hybrid mismatch arrangement rules. So as background, these rules are intended to neutralize the effects of hybrid mismatch arrangements or cross-border tax avoidance structure that exploits the difference in tax treatment of business entities or financial instrument or financial transactions. And the rule was enacted June 20th, 2024, and it's effective for payments arising on or after July 1st, 2022. So there's a retroactive application. There are 3 conditions that all must be met in order for the rules to apply. The first one is that there must be a deduction and non-inclusion mismatch, which we'll go through in an example later. The mismatch must arise from one of three hybrid mismatch arrangements. The first one is hybrid financial instrument arrangement. For example, if you have a convertible loan. The second one is hybrid transfer arrangements, what we typically call a repo transaction. The third one is substitute payment arrangement. This is an anti-avoidance provision to prevent somebody trying to hide that they have a hybrid mismatch. And third, there must be a relationship test or a structure arrangement that is met, so it's one or the other. Relationship test, generally speaking, applies to transfer or transferee or payer and recipients that are not dealer at arm's length, so related parties. Or there's a 25% ownership between the two. On the other hand, if you're dealing at arm's length, the rules could still apply if you're under a structured arrangement. And the two situations are where the economic benefit arising from the mismatch is reflected in the pricing of the transaction, or if the transaction was designed specifically to give rise to a mismatch on purpose. If the rules were to apply, there's three operative rules that could be applicable. So the first one is where you have a Canadian payer paying to a non-resident person. So Canada, you're getting a deduction. So the first rule would deny the deduction to the extent of the mismatched amount. The second rule is where the Canadian company is a recipient from a non-resident and there's no income inclusion in Canada. The second rule would give you an income inclusion at the Canadian level. The third rule applies where the first one applies, and if the deduction that was originally taken in Canada relates to interest, so basically your interest is denied, that denied interest is deemed to be paid as a dividend instead, and for withholding tax purposes, which generally is a bit higher than on interest. So here's an example of a hybrid mismatch situation. So we have ACO, which is in country A. It owns 100% of the shares in Canco, which is in Canada. And ACO makes a convertible loan to Canada, whereby when the Canadian company pays an amount to the ACO, the interest expense, it is treated as interest expense for Canadian tax purposes. However, on the receipt, ACO's per country A's tax law, the receipt is considered exempt dividend income, so there's no tax. There's no income in ACO. So essentially, you have a deduction in Canada and a non-inclusion in country A. So the first test, is there a deduction and non-inclusion mismatch? The answer will be yes. The second one is there a mismatch that arose from hybrid financial instrument arrangement? So one of the three categories that we mentioned earlier, and the answer is yes, convertible loan is one of the three criteria. And the last one is the relationship test or the structured arrangement test met? In this case, they're not dealer at arm's length because it's 100% held. Canco is 100% held by ACO, so the relationship test is also met. Therefore, the 18.4 sub 4 will apply to deny the interest deduction, and the interest is also deemed to be paid as a dividend instead of interest, and withholding tax would apply to that. As earlier, Jamie and John has talked about the trickle-down effect of the capital gains change. So international taxes will also be affected. So for example, FAPI, foreign accrual property income, on disposition of non-excluded properties. So generally speaking, if you have a foreign affiliate that holds non-active business assets, and when they sell those assets, in the past, 50% of the gain will go to exempt surplus, which can be distributed tax-free. The other 50% will go to taxable surplus, but also because it's not for active business purposes, it's taxed immediately in the Canadian company's hands. So now 1/3 will go to the exempt surplus, 2/3 will go to the taxable surplus, and naturally your FAPI amount will be higher. The second change is to the hybrid surplus, and just to give you a background, hybrid surplus arises when you have a foreign affiliate that sells the shares of another foreign affiliate. Any gains and loss related to that is going to hybrid surplus. And the reason why it goes to hybrid surplus instead of half exempt or half taxable is because they don't want you to be able to strip out the exempt portion without distributing the taxable portion as well. So they kind of combine it together. So with the changes to the capital gains, they're introducing two terminology. One is legacy hybrid surplus and successor hybrid surplus. Legacy hybrid surplus essentially just tracks the old existing hybrid surplus pool, whereas successor tracks any pool that's accumulated since June 25th, 2024. And the difference would be when you make a distribution. First of all, there's an ordering rule. You must pay out of the legacy hybrid surplus first, then the successor pool. And the amount of taxes paid at a local jurisdiction will need to be higher to cover off the taxable portion if you want to be, when it comes out, you want to be fully sheltered. Lastly, the upstream loan rules are also affected because of the changes to the hybrid surplus. And as a background, upstream loan rules apply where for example, you have a Kenyan company that has a payable to your foreign affiliate that's outstanding for 2 years. There's income inclusion at the Kenyan level. You may get a deduction if you have sufficient surplus pools at the with respect to the foreign affiliate, including the hybrid surplus. So now that there's changes to the hybrid surplus rules, the deduction that you will get is also affected. Okay. And the last topic is Regulation 105. So again, as a background, Regulation 105 is a withholding tax mechanism on payments to non-resident person, that is a fee, commission, or other amounts in respect of services rendered in Canada, and they're subject to a 15% withholding tax. So if Canco has a contract with USCO to perform services, and a portion of the services are performed in Canada, USCO may choose to subcontract that to its Canadian subsidiary. And so CanSub will invoice USCO, and USCO will invoice Canco. There were some clarification that was made in the 2007 Tax Court of Canada decision that reimbursement of travel and meals and entertainment incurred by non-residents are not subject to the withholding tax, even though it could be part of an invoice. In 2008, the CRA issued a document to clarify that if you split out the payments, split out the items in your invoice, whether it's for services or for reimbursement. If you make that clarification, then the amounts will not be subject to withholding tax. At the time, they also said the subcontractor fees, so the fees that CanSub is charging the U.S. company, will also not be subject to withholding tax. However, in 2019, one of the documents that CRA released said that it would, and that's the biggest change here. So in 2024, they released a new document which basically reiterates the 2019 CRA document, essentially confirming that they acknowledged that there was a change in view in 2019 that they compared to the 2008 document, but that they do think that the subcontractor fees, including Canadian subcontractors where they perform services in Canada, that should be subject to withholding taxes. Given the change in views, the CRA is providing administrative relief until September 30th, 2024. So some things to consider. So where taxpayer intends to rely on the temporary administrative relief, they should ensure that they meet conditions set out in the 2008 CRA document. And in agreements with non-resident contractors, it should be clearly stated that withholding tax will apply on reimbursement of subcontractor fees for services performed physically in Canada. And it would be important to indicate which party will bear the withholding tax liability. Taxpayers should also ensure that non-resident contractor submit invoices that separately identify disbursements compared to fees that's actually related to services rendered in Canada, as the former would not be subject to withholding tax, whereas the latter would be. And lastly, there was in the budget proposal for 2024, there's a new proposed rule with respect to Reg 105 withholding waiver. So generally speaking, there's a withholding tax requirement. However, if a non-resident person is ultimately not going to be taxable in Canada, generally speaking, they would file a treaty-based return. However, you need to wait to get your refund of the withholding tax. So what they could have done in the past is they can file a waiver application in advance of the transaction. And if approved, they can get, the payer would not need to withhold the withholding tax, so that's better for cash flow. Under the current rule, The waiver is for specific transactions, so once you get into contract, you can apply for the waiver. Under the proposed rule, the waiver will be for a specific period of time rather than for specific transactions. So if you have multiple contracts, this will be more helpful in the future. There's not a lot of details of that just yet, but the measures will come into force upon royal assent. And that concludes my segment. I'll pass it on to Sun Kim, who will be talking about the mining sector update.
Thanks, Howard. Before we have Sun step up and talk about the mining, just wanted to remind, if you do have any questions on your cards, feel free to hold them up and our admin team can gather them for you. If you're watching online, we ask that you send the email address of the different presenters will be shown online after. So if you do have any questions, you can email the presenters directly afterwards. But for those of you here, feel free to hold up your cards and we'll try and address them during the session. So thanks. And Sun Kim to talk about mining.
Nice to see you all today. My name is Sun Kim. I'm a Canadian tax partner, and I'll be providing mining sector tax update for 2024. Today we'll go over the introduction of clean technology manufacturing investment tax credit, the impact of capital gains changes for flow-through shares, the impact of minimum tax changes for flow-through shares, and some of the other updates. So Budget 2023 and 2024 introduced a refundable investment tax credit for clean technology manufacturing and critical mineral extraction and processing equal to 30% of the capital cost of eligible property. As the title suggests, this investment tax credit is available for both clean technology manufacturing and critical mineral extraction and processing. But we'll cover the topic today specifically from the mining sector perspectives. So what is CTM ITC? So again, it is a refundable investment tax credit for taxable Canadian corporations equal to 30% of the capital cost of eligible property associated with eligible activities in critical mineral extraction and processing. So what property qualifies? The eligible property must be situated and intended for use exclusively in Canada. It must have not been used for any purpose whatsoever before it was acquired. And it must be included in certain CCA classes that generally falls under mineral extraction and processing, such as equipment used to crush rocks, certain specialized tooling, and non-road vehicles and automotive equipment, such as vehicles designed for extracting rock from mine sites. Also, the property must be used in a qualifying mineral activity, producing all or substantially all qualifying materials. So qualifying mineral activity includes mainly extraction of resources from a mineral deposit or from a tailing pond, a mineral processing activity performed at a mine site, or a certain recycling activity. So the qualifying materials refer to the 6 key critical minerals essential for clean technology supply chains. These are lithium, cobalt, nickel, copper, graphite, and rare earth elements. Budget 2024 also introduced eligibility for polymetallic projects. So these are projects engaged in the production of multiple metals. If the project is expected to produce primarily one of the qualifying materials, The primary test here means the eligible property must be used for activities in which 50% or more of the financial value of the output comes from qualifying materials. You'll also need a attestation from an arm's length qualified engineer or geoscientist. So it comes into effect, it'll apply for property that is acquired and becomes available for use on or after January 1st, 2024. So property that is acquired before 2024 does not qualify for the credit regardless of when it becomes available for use. How much can you claim? So the credit rate is 30% until 2032, and it will gradually phase out and no longer be in effect for property that becomes available for use after 2034. How to claim this credit? So the credit is claimed through the T2 return, the Schedule 31, which must be filed by the filing due date of your T2 return. So this is 6 months after the year end. Overall, the tax credit is expected to have both positive and negative environmental impacts. The tax credit encourages extraction of 6 key critical minerals essential for clean technology supply chains. But increased mining activities could directly increase emissions of certain greenhouse gases. Moving on to the capital gains changes that impact the flow-through shares. As Jamie previously mentioned, Budget 2024 introduced the increase in capital gains inclusion rate from 50 to 2/3 for capital gains realized on or after June 25th, 2024. This increase for some flow-through share investors will have a substantial impact given the tax cost of a flow-through share is typically nominal. So since the sale will now be taxed at 2/3 instead of 50, it'll have a pretty big impact. So to provide some relief, this is for individual taxpayers only. Capital gains up to $250,000 annually will remain subject to the old inclusion rate of 50%. Moreover, changes to the AMT rules will impact individuals who invest in flow-through shares with 2 separate issues in relation to their investment. So at the time an investment is made, so this is when a deduction is allowed. Under the old rules, deduction of resource expenses was limited to resource income. So unless the individual had resource income, no deduction was allowed for minimum tax purposes. But under the new rules, deduction is not limited to resource income anymore, so a full deduction will be allowed. When the flow-through shares are sold, so this is when the capital gains are realized, under the old rules, only 80% of the capital gain was included for minimum tax calculation. However, under the new rules, full 100% of capital gain will be included for minimum tax calculation. Removing the limitation for the deduction of resource expenses would certainly lower the minimum tax at the time an investment is made, but increase in capital gains inclusion rate would increase the minimum tax at the time flow-through shares are sold. Combined with the AMT tax rate change from 15% to 20.5%, flow-through share investors will require additional forecasting prior to making an investment decision. Changes will also impact individuals who donate flow-through shares. So as a refresher, the tax impact or implications of donating flow-through shares are, this is in addition to your resource deduction and the METC that you get, you receive a donation tax credit that equal to the fair market value of the shares donated. but then you also realize a capital gain from deemed disposition of those shares. So under the old rules, 100% of these donation tax credit was allowed for calculating for the purposes of minimum tax. But under the new rules, only 80% of donation tax credit is allowed for the minimum tax calculation. Also, under the old rules, only 80% of capital gain upon donating flow-through shares was included for minimum tax calculation. But under the new rules, full 100% of the capital gain will be included for minimum tax calculation. So combined with the lower allowance of donation tax credit, higher capital gains inclusion rate, and the higher AMT tax rate, flow-through donation is surely expected to yield a higher minimum tax under the new rules. Some of the other updates include updates to BC Mining Exploration Tax Credit, or BC METC. As a refresher, BC METC is a tax credit available for eligible corporations for incurring certain exploration expenses in BC. Expenses that are eligible must be incurred for determining the existence, location, extent, quality of a mineral resource in BC, and typically includes prospecting, drilling, entrenching, and geological expenses. So the credit rate is 20 or 30%, depending on the location of the mineral resource. So previously, the credit applied to exploration expenses for all base and precious metals, as well as oil and gas. But the BC Budget 2024 introduced exclusion of exploration expenses for oil and gas from BC METC. This is effective February 23rd, 2024. So oil and gas expenditures are no longer eligible for the credit, but if you incurred the expenditures up to February 22nd, 2024, this will still be eligible for the credit. This change is consistent with the federal elimination of fossil fuels from the flow-through share regime, which was effective starting April 2023. There are some updates to the mineral exploration tax credit as well this year. This is known as the METC. As a refresher, METC is a tax credit for individuals who invest in flow-through shares. You get 15% federal tax credit plus provincial tax credit if one qualifies. So METC was set to expire on March 31st, 2024, but Budget 2024 extended it for another year, expiring on March 31st, 2025. The previous extension of the program was for 5 years, from 2019 to 2024. So it would have been nice to see it extended for 5 years instead of 1, but the credit has been around since 2000, so it'll very likely be extended again in Budget 2025. This is separate from CMETC, the Critical Mineral Exploration Tax Credit. This was introduced back in 2022 to encourage exploration of 15 specific critical minerals, and that one is set to expire in 2027, so different credits. So a bit of a quick one, just to recap today's update. So there's an introduction of clean technology manufacturing investment tax credit for capital cost of certain eligible properties. 2, increase in capital gains inclusion rate will result in higher taxes for flow-through share investors. 3, changes to the minimum tax changes will impact flow-through share investment decisions as well as flow-through share donation decisions. And lastly, BC METC no longer includes oil and gas expenditures as eligible qualifying expenditures. and METC is extended for another year to March 31st, 2025. That's all from me.
Thanks, son. So yeah, I know over the years, there's been those arrangements where you invest in flow through and it's donated, and normally you end up with getting a tax break out of it. Certainly that's something that you want to be cautious of going forward, since these new rules are going to impact all parts of that. So I'm sure that they'll probably be adjusting those, but we'll see what the end result will be. But just more of a word of caution if you are investing in such arrangements, that it may not have the same tax effect as it used to, and you might end up having to carry forward the resource expense pool if you want to avoid the AMT and not taking the deduction in that year. So just something to keep in mind, and I know for a tough one for a lot of the mining clients that rely on that for a source of capital. So hopefully we'll see changes down the road to that. So we still have a bit of time left, so we'll hand it over to Manisa to talk about the U.S. tax. And again, if you do have any questions, feel free to hold up your card and we'll gather those from you. Thanks.
Thank you everyone again for joining us. Can you hear me in the back okay? Okay, I just want to make sure. Just to introduce myself, my name is Manisa, I'm the U.S. tax principal. To round out this year's annual tax update, we're going to go south of the border and give you a U.S. tax update. The hot topic for this year is the U.S. 2024 U.S. election, which is set to happen November 5th. So we are going to go over essentially what the Democratic and Republican candidates, how they view the taxes and what they are proposing. Before we do that, I do want to go back in history a little bit so that we can see where we are now. There is legislation expected to sunset in 2025. The global minimum tax that Howard mentioned is also going to impact some legislative changes as well. And finally, the comparison between the Democratic and Republican Party. So to start with the US tax history, we can oversimplify it by separating it into two categories, which is pre-TCJA, which is the Tax Cuts and Jobs Act, and post-TCJA of 2017, which was enacted by Trump. I will also go over the Coronavirus Aid Relief and Economic Security Act, or otherwise known as the CARES Act of 2020. So starting with a comparison for corporations, I'm only going to go stressing the important ones high level. The big major change was the corporate income tax rate, which historically was in a bracket system with a top rate of 35%. That is quite high relative to other countries. That was lowered by the TCJA to 21% to make it more competitive. For the bonus depreciation, historically that has always been 50% on qualified property and had to be new property. TCJA changed that and increased the bonus depreciation to 100% and included purchased used property as qualified property, which significantly increased the depreciation deduction that corporations were allowed. There was also a new business interest limitation, which is limited to 30% of the adjusted taxable income. And the net operating losses historically has always been similar to the Canadian rules, which is a carry forward of 20 years, expiring after 20 years, and allowed a carryback of 2 years. The TCJA changed the net operating losses so that losses did not expire. They could be carried forward indefinitely. However, there was a limitation that was set that you could only use the losses up to 80% of taxable income. What that meant was even if you have a large net operating loss pool, where you have taxable income, you will likely have some sort of taxes payable to be made. And the carryback was fully eliminated. Moving on to individuals, historically the top marginal rate was 39.7%. This was lowered to 37%. And the U.S. has what's called a standard deduction, so similar to the Canadian basic personal exemption. This historically was always was around $5,000-$6,000 adjusted for inflation every year. So in 2016, this was $6,300 for a single filer. TCJA doubled this figure, so essentially would be around $14,000 or $15,000 per year. And so the system works where that you can take either a standard deduction or an itemized deduction, and the individual taxpayer can choose whichever is more beneficial for them. And historically, miscellaneous itemized deductions were allowed to the extent that it exceeded the 2% of the individual's adjusted gross income. So this included things like unreimbursed employee expenses, advisory fees, tax preparation fees, a few other things that fell under that category. This was limited. The sales and local tax was limited and capped to $10,000. There was mortgage interest deduction was also limited, and the miscellaneous itemized deductions were essentially all eliminated or suspended. There were also some other changes. Moving expenses were eliminated except for those that were in the armed forces, and alimony was neither deductible nor taxable. So effectively what happened with the TCJA is that most people it was not advantageous to take the itemized deduction, and basically were capped at the standard deduction even though that was doubled. For estate and gift tax, there were also significant changes. So this is the lifetime unified credit, which is shared between the gift tax and the estate tax. If your estate fell under $5 million previously, you would not be subject to estate tax. The TCJA changed this so that it doubled. There were some other significant changes that resulted in the TCJA. So there was a new rule, which was the pass-through income deduction. Essentially, this allowed non-corporate taxpayers who had an interest in pass-through entities to get an additional 20% deduction. This was to level the playing field for the reduced corporate tax rate. There was also a one-time deemed repatriation tax in 2017, so all the earnings and profits of controlled foreign corporations became taxable. Another significant change is what's called GILTI, which is short for Global Intangible Low Taxed Income. Essentially, it was a worldwide minimum tax on foreign earnings, and it's deemed income for the person, U.S. shareholder of a CFC. Effectively, there was also a 50%, up to a 50% deduction of the GILTI inclusion. So if you take that in effect of the 21% corporate tax rate, the effective rate of GILTI was 10.5%, meaning if you paid at least 10.5% in the foreign jurisdiction, there would not be additional tax, but if it was under that, this minimum tax would kick in. So the CARES Act did implement a few changes. The employee retention tax credit, which was an incentive as a result of COVID. There was also a change to the net operating losses that I discussed earlier. Basically, it gave a grace period. Was the losses from 2018, 2019, and 2020 carried forward were not limited to the 80% taxable income and only what became effective for tax years that begin after 2020. They also allowed for those years, 2018, 2019, and 2020, a carryback up to 5 years. So moving on to what we can expect, I want to cover what is the legislation that is sunsetting and what is not sunsetting, so we can kind of anticipate the changes in the future. For corporations, the bonus depreciation is going to completely phase out over the next few years and be completely gone by 2026. The pass-through deduction, that 20% that I spoke about, is no longer available. For individuals, essentially everything that came into effect by the TCJA is going to revert back. They will expire, they will sunset. So the top marginal rate will go back up to 39.6%. The standard deduction will go back to half of what it was. The miscellaneous itemized deductions will be allowed again, and the estate and gift tax will be split in half, which is quite significant, from $12 million back to $5 or $6 million. What is not sunsetting in 2025 is the federal corporate tax rate is remaining at 21% for the time being, unless changed. And it is the shift to a territorial tax system is also going to remain. So the GILTI that we spoke about, the Subpart F rules, which have been around for a while, those are sticking around. So to cover the global minimum tax a little bit, because that is going to influence legislative changes, is from the OECD to propose an internationally agreed upon minimum rate of taxes of 15%. So this is to ensure that multinational enterprises pay a minimum level of tax in each jurisdiction in which they operate. So it's an incentive to stop the race to the bottom on corporate taxes where countries are lowering the corporate tax rate. The U.S. federal system has not yet adopted the global minimum tax. The current tax rate is 21%, which is higher than the 15%. This does not mean that it is compliant for a number of reasons. The way that they calculate the taxable amount is different than the model rules. And the GILTI, which is similar to this minimum tax idea concept, pools all the foreign jurisdictions together. So it is not country by country basis, which the GMT rules, that's how the GMT rules would apply. The GILTI you can net. So income in one jurisdiction can be offset by losses in another. The result of this is anticipating lower U.S. tax revenues, higher foreign taxes, so higher taxes paid in a foreign country means that U.S. companies that are subject to this are going to be allowed a higher foreign tax credit. There's also going to be an increase in compliance costs and probably a decrease in the amount that's distributable to the shareholders. So there is going to be a legislative response necessary to mitigate the downsides. Finally, moving on to where the Democratic and Republican presidential candidates, specifically Vice President Harris and former President Trump, stand on taxes. Not to get too political, just to compare on corporations and individuals. So Vice President Harris is proposing to increase the corporate tax rate, which is now 21%, to 28%. That has been kind of flown around for a little while now, also by the Biden administration. The startup cost deduction is, whereas Trump is proposing to, again, lower that rate to 20%. Vice President Harris is proposing the startup cost deduction to be increased to $50,000, which is now currently at $5,000, and also increasing the GILTI tax rate to effectively increase revenues and probably combat the global minimum tax rules. Whereas Trump is proposing to have a universal baseline for tariffs and trades, and also a specific rate on U.S. imports from China. For individuals, they do both agree that to exempt tips from income tax. Vice President Harris is proposing to increase the Medicare tax, which is essentially a Social Security tax, to 5% on income exceeding $400,000. Trump is effectively proposing to not let the TCJA rules expire and make those permanent, and so those would not sunset. Things like the lowering the individual tax rate, the deductions, and the estate tax. So regardless of the outcome of the election, what we can expect or be certain of is that there are going to be changes ahead. I think the question is, how will you plan for it? And that wraps it up for me. Thank you.
Thanks, Manisa. So it looks like our presenters have done such a great job on their topics that there are no questions. So that's fantastic. Before, I thought I'd take the last couple of minutes and just, oh, okay, sorry, go ahead. Did you want to come up, Lisa?
Yeah. This is a quick one. It's just asking regarding CTM-ITC. So 90% of qualifying metal requirement, i.e. copper, cobalt, etc. How is the 90% determined by gross dollar value or gross weight? So I believe this is financial value of the output. So yeah, it'll be the dollar value of the metal instead of the gross weight.
So before you go, Sun, there was one more question that has come up commonly with clients that I thought sharing with the group here might be beneficial. So with the overlap of the rules, with the clean technology ITC, are those expenses also able to be renounced for flow-through purposes?
So the capital cost of a depreciable property is not eligible for flow-through shares or flow-through renunciation. So if an expenditure qualifies for a CTM-ITC, that means the expenditure will never qualify for the flow-through purposes. Yeah.
Go ahead.
It applies to manufacturing companies or other sectors, but we just focused on the mining sector specifically.
Yeah. Thanks. Yes, that's I think a common confusion because of the way that they rolled it out. That it seemed like the two were overlapping or related, but because it's a capital expenditure, they would be separate. So the company just gets the tax credit refundable, but they can't pass it on to the investors. So. So one more question, I think, just to maybe help the folks with the on the capital gains side. So this one's for Jamie and John. Whether you have any tax planning suggestions in light of the increased inclusion rate.
That's a loaded question. That's $1 million question. Yeah, I knew this question would interest a lot of people. What you should do. I think for individuals, obviously take advantage of that threshold. So the first $250,000 of your capital gains are going to be eligible for that 50% inclusion rate. So I guess where possible, try to smooth out your capital gains over years. If you're going to trigger $1 million of capital gains, is there a way you can spread that over 4 years so you don't get hit with that higher inclusion rate? I think for people that have corporations with investments already in that, you definitely want to start thinking about possibly getting those investments out of the corporations. John and I were talking about that, start to look at, investing through your RSP, TFSAs and things like that, because obviously there's no threshold or ramping up in corporations. And I would say, if you have funds personally, and you're thinking about investing, and common question we get is oh, should I take that money and set up a corp and invest through that corp? You can see the math in our slides. It's really disadvantageous to hold investments in corp. So probably think twice about that. So that's all I got. I'll leave it to Les.
Thanks, Jamie. Thank you again for everyone joining us today. I just want to take the opportunity also to thank all of our presenters as well as all of our admin team for putting this on. It takes a lot of effort and work on their parts to do so. So I just wanted to say thank you to our group for doing so. Just another reminder, when you get the email with the survey, please fill it out. We can get your thoughts and anything we can add or change that will improve it. We'd love to hear from you, and you get your PD credits that way too. So, and along with the slides. So, thanks again, everyone, and look forward to having a drink with you. Thanks again.
What makes us the go-to auditor for public companies is we take a client-centric approach.
We perform a variety of audit-related services.
Of course, we do public company audits, interim reviews, initial public offerings, secondary offerings, and we do internal controls audits as well.
We perform audits across many different industries. Some of them are renewable energy and mining, crypto, cannabis, technology, and manufacturing.
Being a part of Nexia allows us to have global reach, having affiliates in almost every country in the world.
Being a member of Nexia allows us to tap into local expertise and deliver cost-effective audits and bring value to our clients.
We are experts in acquisition transactions as well as all financings for companies going public.
So at the firm here, we're agnostic to the industry. We're market-driven. When the market chooses a new industry, we build up our expertise to learn how to do it.
Having the same audit team allows both us as auditors and our clients to realize efficiencies, utilizing accumulated knowledge year over year, so that we can help you anticipate and solve your problems.
What sets us apart is our audit team is always available. You can pick up the phone and get a hold of us.
But I would say the biggest one is the people. Our name in the market and even internally, we are the people as you see. We are represented well by our personalities and our agility. I think that's why people come to us.
In the context of audit engagements, our agility ensures that we swiftly adapt to the evolving needs of our clients. Our service exemplifies integrity by consistently delivering honest and transparent solutions.
Clients like us because we treat their business as if it's ours. We look at their success as our success.
We're with you every step of the way, helping you navigate evolving tax requirements all year round.
We really want to make the lives of our clients easier, as there's already enough to do with running a company.
Well, we have a real broad range of clients, starting from public companies and international tax clients to private small business. We also work with a lot of trusts and estates, as well as a lot of individuals and meeting their personal tax needs.
Yeah, so tax is not an easy topic, but it does affect everyone and every company. So our goal is to make our clients' life easier by simplifying complex tax issues, by keeping their situations top of mind so that when we dive into new tax developments that we can keep them in the loop, and to provide prompt and personal responses to show that we care.
We provide compilations, review engagements, corporate tax preparation and planning, plus private company audits.
We operate in various industries in the private entities sector, including tech, manufacturing, real estate, retail, professional corporations, investment holding companies, and a lot of foreign entities operating in Canada.
I really enjoy that we're an integral part of our client's business, adding value through exceptional services.
Our affiliation with Nexia not only benefits us by allowing us to approach a larger client base, but it also allows our clients to have the opportunity to work with other amazing tax practitioners that might be situated in different jurisdictions, such as Australia, the United States, or in the UK.
I love being that go-to advisor for my clients and being able to help them solve their esoteric problems with as practical of a solution as possible. I love seeing the impact that I have on clients' business and their finances and their general well-being. I love being a mentor to our staff and to help them learn as much as possible.